All right, well, we're gonna get started. We're gonna be recording this as well so that we can send it out. There were a lot of people that couldn't make it because it's during the workday, which I completely understand. So we'll record this, send it out for people who would like to understand this. So I am going to share my screen. Maybe. There we go. All right, so I'm going to share my screen and we are going to talk about if you are buying for the first time, if you are buying as a move-up buyer, things that you should be thinking about and aren't if you are going to be buying in 2024. So I could have talked for 9 days on this subject, but we compiled a few and we're going to touch on some and maybe go deeper on others if people want, otherwise do additional follow-up on them. All right, so the biggest thing to know is that right now, as we are starting to head into the spring market, every house is its own market. And what I mean by that is there are some houses that are on the market, have been on the market for 2-3 weeks, and you can absolutely negotiate, absolutely try to get seller concessions, and have just a little bit more wiggle room with them. There's other houses that are coming on that within 2 days have multiple offers. So every home is going to be different, and based on the needs of you as a buyer, that is what you should craft your search towards. If you absolutely have to have, some buy downs or some things like that we're going to talk about, you really should be looking at your search for anything maybe that's been on the market for a couple weeks, because to try and get some of these things in a multiple offer situation could be challenging, not impossible, but could be challenging. So we'll talk through that as we go. So first and foremost, the market is competitive. We're already seeing it. So I'll give a quick example. This weekend, we had 8 clients that made offers on properties, and 4 of them got it. 5 of them were in multiple offers. So what that means in my very small scope of serving my own clients, 50% of the offers were, a little over 50% were in multiple offers, and half won, half didn't. So really, when we're talking with clients, really when you're talking to your agent, how can we make the offer the most? Yes. All right, so how to make your offer the most competitive. Number one, in general, price is important. So offering less than the list price, if it's recently come on the market, is probably not going to be helpful. And really making sure that your agent is clear on what's important to the seller. Is it a quick close time? Is it the most competitive price? Is it they want some other things? So make sure that your agents are asking what matters to the seller, because I guarantee you it's not just price, but price is one of the top 3. Another thing on how to make things competitive, doing a rent back. So one of the biggest concerns for people that are selling their home and going into looking for their next home is, are we going to be able to sell this and find a new place to live or in time? So a rent back means you allow the seller to stay after you've closed for maybe a week, 2 weeks, a little bit of time, so that they have time to move and find their next house or close a little bit more later than this house. They don't have to wrap them up together. So that's something that sellers definitely are interested in. Appraisal gap. Appraisal gap coverage is one of the things that when you make an offer, the financing is based off your purchase price or your appraisal, whichever's less. Okay, so if the purchase price is higher and your appraisal comes in a little bit lower, it means that you're going to cover the gap of that appraisal. So that could be a whole Zoom and Learn in and of itself, And if anyone wants more details on that, I have a one-page document that really goes through it to explain it in more detail, but that is one thing that will make your offer more competitive and what we're seeing right now. Another one, buyer paid closing costs. So when a seller is selling their home, they have closing costs. So sometimes we have seen, not so far yet this year, but in previous years, we have seen that the buyers offer to pay some of the seller closing costs. That's a way to make your offer more competitive. A seller contingency, meaning if a seller has got to find a new property after you purchase theirs or after you make an offer, you can give them, hey, you've got 90 days to find a new property. That's a long time for them to have the ability to look and find the right property versus real quick because we want to close in 30 or 45 days. So give them the time frame of a seller contingency that they can also get out of the contract if they can't find something in 30 or 60 days. Escalation clause, not all agents will do this, but an escalation clause basically would go with an offer that says, hey, our client will offer $1,000 or $2,000 more than the highest offer up to X number of dollars of the purchase price. So again, some agents will not do those. Some receiving agents or listing agents do not like those, but it really depends on what your agent thinks and the feedback from the selling or listing agent. Okay. All right, if I keep going, next page, we've got removing your contingencies. So when you make an offer, there's certain contingencies that you will typically write in your offer, meaning we've got a house to sell, or we've got a financing contingency, or we've got an appraisal contingency, or excuse me, or inspection contingency. So removing some of those contingencies will make your offer more look better in the seller's eyes. The less things that can get the seller hung up on, the more attractive your offer is. So a couple of things to think about. If you have where you want to sell because you need the money for the down payment or qualify, we could look at different bridge loan options, which could remove your contingency for having to sell your property. We have programs where could offer and we could get a guaranteed offer on your home if it doesn't sell. So again, removing the contingency that you would have to sell your home prior to closing on the new home. If you're going to rent out your departure home and you don't want to sell it, again, you can do that, but there are some contingencies there as well, meaning you would have to have a contract on your home, excuse me, a lease on your home and first month's rent. You could do that early and not start that lease for 60 days. That would remove your contingency of needing to sell. Financing contingencies, again, when we are doing our approval, we are putting you through a complete underwrite. And we actually have a $20,000 guarantee that goes out with every pre-approval letter that we write. So really, a financing contingency for us is only subject to clear title and appraisal. So again, I think our financing is pretty much as good as cash, but waiving any of that financing contingency would be a better way to make your offer look more attractive. Also, you could make your earnest money go hard, which means that after a certain amount of time, if something falls out with financing or if you change your mind, the seller keeps that earnest money, period, end of story, black and white. Another option. Waiving the inspection. Now, I know this is not a popular one at all, and I understand it, but we unfortunately did have 2 clients that lost because they didn't want to waive their inspection. So again, if you are just really like, I do not want to waive my inspection, I want to make sure that this property is in good shape, then you may want to look at properties that have been listed for a little bit longer period of time. And you will have a better chance of being able to negotiate with those folks and have an inspection accepted. Okay, so those are a few things with contingencies. So that was basically, how can we get your offer accepted? What makes it look attractive? What are the things that are in your control to make your offer stand out? Now, one of the other big things that we are talking about is affordability. Interest rates are up, home prices are not coming down. It does not look like at all, even when rates hit 8%. We didn't see a whole lot of backdrop with home prices. So here are a couple of programs to potentially help with affordability. One of the caveats that I can tell you is that sometimes these programs are going to have a little bit harder time getting accepted in a competitive multiple offer situation. So a lot of times these are the things that if you want these types of programs to help you, again, you may want to look at properties that have been on the market a little bit longer that have negotiation room. First and foremost, buy downs. This is a big one, and it was very popular over the winter months. It's still popular right now, but it is hard for, I know that's a whole lot of numbers, don't freak out, I promise it's okay. But it is one of those things where it has so much impact to the buyers to help with their monthly payment. But the caveat is you do need the seller to contribute. So basically what this is a calculator of what a temporary buy down would cost. A temporary buy down simply means that if the current interest rate is 7.2, if you did a 2-1 buy down, it means that your interest rate year one is going to be 5.2, year two, 6.2, and not until the third year do you get to that 7.2. Now, the amount of money that this costs is this. So the seller would have to do seller paid closing costs in the amount of basically $11,800 to cover that for you. You cannot, as a buyer, cover a temporary buy down on your own. Has to be the seller, has to be the builder. But it does make so much impact because look at the first year, this is a $500,000 home at 7.2. The P&I payment, so principal and interest, would be $3,393. But if you were able to do a buy down year one, the payment would be $2,745. Year two, $3,062. Again, this is just principal and interest, so property tax and homeowners insurance is on top of this. But that's a massive savings as you're getting used to jumping in and owning a home or townhome or condo and acclimating to a mortgage. So they're very impactful, but sometimes hard to negotiate because you need the seller's help. Now, some people say, well, why would the seller do this? Well, there are some sellers that price their home too high and they have to drop their sale price. So I just did a very quick example. This was one that we did in January. House was priced at $525. We need to get the price down to about $499. So that reduction means $26,000 of a sale price reduction for the seller. But if we did, if we did a temporary buy down, and even if the seller contributed 3% towards those, they would then be contributing $15,750, and they would not be dropping as much in sale price, but the buyer would have a lot of benefit from them paying those closing costs and actually keeping the sale price where it is. So again, the seller didn't have to drop and lose as much on what they were earning when they sold, and the buyer was able to save in the first 2 years of their mortgage by doing this temp buy down. So again, everyone is winning. All right, so that's all I'm going to talk about with buy downs. Like I said, I could do a whole spiel on just that alone, but if you've got questions on it, ask. Down payment assistance. So again, part of the affordability, there's a lot of people out there that can afford the monthly payment, but cash out of your pocket is a challenge. So that is one of the things where this definitely helps bring the monthly payment available, but makes the cash to close less. So a lot of times these down payment assistance do usually need to be paid back either via monthly payment or when the home is sold, when it's refinanced, or when you no longer own or occupy. So here are some parameters on that down payment assistance. So if you're a first-time buyer, you can get up to 18,000. If you fall into the deferred category, that means that you do not have any payments or interest for 30 years, or as long as you own the home, own or occupy, and do not sell it or refinance it. Again, no payment or interest for 30 years. Those are the income limits, and it's based on household. So if you are a husband, a wife with 2 kids, your household is 4. Max loan limit, those are limited at 515,200. This one is available for first-time buyers and repeat buyers. You get up to $18,000. You do have a monthly repayment. It is $18,000 repaid over 10 years at whatever the interest rate is on the first mortgage. And the max income limit is $185,700. So again, there is assistance not just for first-time buyers, but repeat buyers if you fall into those income categories. Grants. Grants are basically free money, and I very rarely say free money, but they are free money. They do not require it at all to be paid back. And again, they are just utilized as funds towards your closing costs and prepaids, anything that you want towards the transaction. So if your income limit is $62,180 and one of the qualifying people is a first-time buyer, you would qualify for $2,500. Same category, if you're at $99,440, you qualify for $4,000. So again, first-time buyer, one of the people on the mortgage has to be a first-time buyer, and both people, if you're both on the mortgage, have to fall into that income guideline. Student loans. This is another piece that I throw into affordability because student loans are a big issue for a lot of people. So doesn't matter. I know most student loans are required to be paid back now, but there's still no penalty if you don't pay them back this year. So they're not marking you late on credit or anything like that. So even if your loan is deferred or in forbearance, we have to use a payment against you via your student loan. So for conventional financing, 0.5 to 1% of the outstanding balance, or unconventional, we can use income-based. So there have been people that had $100,000 in student loans, and because they used an income-based repayment plan, their monthly payment was $100. That's great. Unconventional, we can use $100. If you don't set up an income-based repayment plan, then we have to use 0.5% or 1%, depends on the investor, Fannie Mae or Freddie Mac, that we are going to. FHA and VA is always a 0.5% of the outstanding balance if the payments are not reporting, or if you're in forbearance or deferred, and FHA and VA are not allowed to use any income-based repayments. All right, other things to note that I think people should really be thinking about as they look at buying in 2024. I talked about a temporary rate buy down. You're basically buying it down for the first 2 years. You could buy it down for the first year. You could buy it down 1 point for the first 2 years. There's all those combinations, but it's temporary. It's not for 30 years, it's temporary. So the other thing people are looking at is permanent buy downs. So again, this is where you're paying points to buy that mortgage rate down, but you're buying it down for the next 30 years. It is very unlikely that any interest rates that people have right now on mortgages that start with a 6 or a 7 or an 8 are going to be out there for probably more than 2 or 3 years. It's very likely as interest rates come down, those people with those higher interest rates are going to be refinancing. So looking at doing a temporary buy down is much more cost effective than doing a permanent buy down. Okay. Single pay mortgage insurance. So when you have less than 20% down, you have mortgage insurance. Mortgage insurance does everything to protect us as a lender, does not a lot for you. So when interest rates for 2 and 3 and 4%, we did single pay mortgage insurance all day long. It means you pay it once and you never deal with it again. And the reason that we did that was because those mortgages, because those interest rates were low, it's very unlikely that you're going to be refinancing in the next couple of years to get a better interest rate. We're not seeing those rates again, probably anytime soon, and definitely not better. I hope not better, because that would mean our world is in some other kind of things. So single pay mortgage insurance is not something that I would look at doing right now. Take the monthly, because again, just like the permanent rate buy down, it's very likely that we're going to be refinancing you if interest rates start with a 6, 7, or 8 in the next year or two. And once we refinance you, that is the likely time frame that we would then look at doing a single pay mortgage insurance if you still needed it, because the length of that mortgage is going to be much longer than. I get questions like this all the time. Interest only options. Yes, we have interest only options. However, the rate is much more expensive, because the risk of you not doing any principal reduction means that, again, you're not doing any principal reduction, so the balance of that loan is staying constant. So the rate is much more expensive, and the benefit of the interest only is usually never outweighed, right? At least right now, I should say never, is not outweighed by the higher interest rate. They also require quite a bit more money down. Other things to note, this is just kind of food for thought. Conventional mortgage limits for 2024, single family, 766,550. That means that if you have a mortgage, 766,550 or less, and you are doing conventional financing, that means that it goes to Fannie Mae or Freddie Mac, or that's kind of the overlying umbrella of who those rules are coming from. That's a pretty high amount. You can do up to 3% down on a purchase price of 766,550. It's crazy. A duplex, again, all owner occupied. A duplex, you can go up to 981,550. Triplex, 1,186,000. Fourplex, 1,474,000. Yeah, crazy amount. FHA, VA, so these are our government-backed mortgages. Again, these are 7 county metro mortgage limits. So 515,200 is the mortgage limit. So that means you could have a purchase price above that. So I think it's about 530 that you could be making an offer at. Yeah, about 533, making an offer at and be able to do an FHA loan. Again, a duplex, all of these are going to be owner occupied. So a duplex can go up to 659 for a loan amount, triplex and fourplex 40. Okay. Appraisal waivers. We get this question a lot. An appraisal waiver simply means that when we run your loan through an automated system, that property comes up as not needing an appraisal. And that can benefit you, because if you've got an appraisal gap that you've written in, well, if the appraisal's waived, that automatically takes any concern for appraisal gap off the table. So a lot of times people will ask us if we can get an appraisal waiver. So I put on here what is not eligible for an appraisal waiver. Any 2 to 4 unit properties, regardless of owner occupying or not. Any purchases with less than 20% down. So if you're putting 5, 10, 15% down, no appraisal waiver is available. Rate and term refinance with 10% equity or less. Cash out refinance with 70% loan to value or more. Any investment property. So if you're buying an investment property and not putting at least 40% down, you will not get appraisal waivers, not available. And any second home that has less than 40% down is not available. So again, it's less and less that we're able to get those appraisal waivers, but every once in a while we still have them. All right, so those are the kind of the biggest things that I wanted people to think about as they are thinking about buying in 2024. Are there any questions from anyone that's on, or when we post this online? If there's any questions, we'll certainly go back and answer them. But You can feel free to unmute yourself or put them in the chat, and I'll be happy to answer them. Nope. All right, everyone's shy today, I understand. Okay, so again, there are no questions. So if there's anything else that people want, or anything else question-wise that pops up with regards to the information that we shared today, please reach out. We would be happy to talk to you about it. And of course, happy to look at pre-approving you and showing you exactly what we could do for you in this market, which looks to be fairly competitive in spite of interest rates and home prices. Thanks for watching. Take care.